You may have heard of it either as an economic miracle and a way to finance big, ambitious projects, or as a disastrous economic theory which could lead to hyperinflation and other problems. In this video, we are going to explore what is modern monetary theory. If you're interested in a critique of MMT, please comment down below. MMT basically argues that countries that issue their own currencies can never run out of money the way people or businesses can. So basically, all jokes aside, here's how Stephanie Kelton, one of the biggest supporters of MMT and professor of economics at Stony Brook University, explains it.
What that means is that the federal government is nothing like a household. In order for households or private businesses to be able to spend, they've got to come up with the money, right? And the federal government, it can never run out of money. It cannot face a solvency problem, bills coming due that it can't afford to pay. It never has to worry about finding the money in order to be able to spend.
In traditional economics, the government uses taxes to pay for its expenses. When the government runs out of money, it takes loans by issuing bonds. When the government is taking out loans, it is basically increasing the demand for them, therefore making the loans more expensive for individuals and business owners. When this happens, fewer people are taking out loans to, let's say, finance their new car or house, which could cause economic growth to slow down. Since the government won't usually pay the debt in full the next time that they want to get loans, they will have to default on them or print money to pay the interests, which leads to inflation. When the government defaults on its loans, investors want to compensate the risk by raising the interest rates. And as mentioned before, when the interest rates increases, the economic growth decreases. MMTers argue that a government with a sovereign currency should never default on its loans. MMT suggests that government spending can grow the economy to its full capacity, enrich the private sector, eliminate unemployment, and finance major social programs such as universal healthcare, free college, and green energy. If the spending generates a government deficit, this isn't a problem either. Government's deficit is by definition the private sector's surplus. Increased government spending will not generate inflation as long as there is unused economic capacity or unemployed labor. When an economy hits its physical or natural constraints on its productivity, such as full employment, it is only then that the inflation rates go up, because that is when supply fails to meet the demand and prices go up as a result. The idea of printing money might sound strange to you, but that is basically what Federal Reserve has done for years. Here's Alan Greenspan, former chairman of Federal Reserve from 1987 to 2006, basically saying it.
So having personal retirement accounts is another way of making a future retiree benefits more secure for their retirement. And also, do you believe that personal retirement accounts as a component to a system of solvency does help improve solvency? Because when you have a personal retirement account policy, it's accompanied with a benefit offset. With that feature in place, do you believe that personal retirement accounts can help us achieve solvency for the system and make those future retiree benefits more secure?
Well, I wouldn't say that the pay-as-you-go benefits are insecure in the sense that there's nothing to prevent the federal government from creating as much money as it wants and paying it to somebody. The question is, how do you set up a system which assures that the real assets are created which those benefits are employed to purchase? So it's not a question of security. It's a question of the structure of a financial system which assures that the real resources are created for retirement as distinct from the cash. The cash itself is nice to have, but it's got to be in the context of the real resources being created at the time those benefits are paid, so that you can purchase real resources with the benefits, which of course are cash.
Mm-hmm.
And this guy is Ben Bernanke, chairman of the Fed from 2006 to 2014.
Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively, and we need to do that because our economy is very weak and inflation is very low. When the economy begins to recover, that'll be the time that we need to unwind those programs, raise interest rates, reduce the money supply, and make sure that we have a recovery that does not involve inflation.
When people talk about MMT, one of the biggest arguments against it is that it leads to hyperinflation. Well, it is not exactly hard to tell that governments creating infinite amount of money to finance everything will lead to this. Most economists and MMTers believe that when the total demand for something moves faster than the supply for the same thing, inflation happens. Basically, if everyone wants the same thing and the factory can't keep up with the demand, people will compete with each other to get it, therefore driving up or inflating the price. So how does the MMT controls inflation? You might be wondering why I should pay my taxes if the government can print money to pay for everything. Well, under MMT, taxes serve two main purposes. Number one, taxes make people to use the government-issued currency because they need to pay taxes in that currency. Second, and more important reason, is that taxes are a tool that government can use to control the inflation. You see, when the government taxes people, it is taking money out of the circulation in the economy. It is basically keeping the people from increasing the prices, or in other words, reducing the aggregate demand. Basically, what MMT suggests is that instead of raising interest rates to fight inflation, raise taxes. Now you might be wondering that these MMTers want to increase my taxes and get my money, so I will support those who want to lower the taxes. But as Nobel Prize winner and economist Milton Friedman puts it, they are both basically doing the same thing.
Before every election, our representatives would like to make us think we're getting a tax break. And they're able to do it while at the same time actually raising our taxes because of a bit of magic they have in their kit bag. That magic is inflation. They reduce the tax rates, but the taxes we have to pay go up.
To reach full employment, MMT proposes something called a job guarantee. Job guarantee basically means that governments should offer as a right a job with benefits to every adult who wants one at a minimum wage. The idea behind job guarantee is that to ensure full or near full employment no matter what policies the government uses to fight inflation. When a government raises taxes or starts to regulate businesses, the economy might slow down, and as a result, some people may lose their jobs. A job guarantee can help those affected by these policies. One question that may come to your mind is that why there was no inflation when Ben Bernanke created $1 trillion of money, or according to estimates by the Levy Economic Institute, 29 trillion. To understand this question, it may help to look briefly at the case of Japan. MMT advocates argue that if done correctly, hyperinflation can be a rare event. Let's look at Japan. Japan runs on a deficit of 240% of their GDP, and it does not have an inflation problem. This deficit means that the Japanese government has spent much more than the value of its economy. In fact, according to the World Bank, in the past decades, Japan had many years of negative inflation rates, and in 2019, its inflation rate was only 0.48%. In the US, to counter deflation, the Fed was forced to lower the interest rates close to zero when Ben Bernanke was adding $1 trillion to the economy. In Europe, 19 European countries, including Sweden, Denmark, and Switzerland, have negative interest rate in the hope of creating inflation, while at the same time, the European Central Bank basically created 2.5 trillion euros. So what about all the other countries that printed money and have hyperinflation? To answer this question, let's look at Zimbabwe, where they have $100 trillion banknotes and, according to Vox, 231 million% inflation rate. The situation is so bad that most of the people use other currencies for everyday life. So basically, in the late 90s and early 2000s, once an independence fighter and dictator Robert Mugabe forced white farmers out of their land and gave it to the soldiers who fought with him.
Decades of agricultural experience departed, voluntarily or forcibly. The consequence was that a country which was once regarded as the breadbasket of Africa began to starve. Harvests shrank, shelves were empty, and rampant inflation meant currency became virtually worthless.
As a result of this sudden shift, nearly 60% of the country's production capacity was destroyed. Here's how Bill Mitchell, professor of economics at the University of Newcastle, puts it.
In Zimbabwe, for example, probably for good reason, Mugabe wanted to honour and reward the soldiers that led to the break with the British, but he went about it a very silly way by basically undermining the supply capacity of the economy, which was essentially the farming sector, and destroyed, in a very short time, about 60% of your production capacity. Well, of course, if you keep spending and you can't produce goods to meet that spending, you'll get inflation. If you keep spending on top of that, you'll get hyperinflation.
Something similar happened after World War I in Germany when Allies forced Weimar Republic to pay a lot of money as compensation. The amount was far more than what Weimar Republic could afford, so they printed money to pay for the bills. The war had destroyed Germany's productive capacity, and the result was hyperinflation. Ordinary people needed a wheelbarrow of cash just to get a loaf of bread. MMT argues that inflation happens as a result of a lack in goods, labor, or in general productive capacity. If we want to look at this at a smaller scale, some public companies create shares out of thin air to give to employees as stock benefits. But since their operation and production is growing at a much faster pace, this share creation has little effect on the stock price. Just look at this chart. While I was researching this video, I saw some articles referred to the act of money creation in the MMT as quantitative easing. According to Fraser Institute, a Canadian think tank, although they both contain the act of printing money, MMT and quantitative easing are theoretically different. Under QE, the central bank prints money as a form of loan to the government to address a short-term economic problem. The government should ultimately pay this debt back, but under MMT, the central bank creates money with no expectation of getting paid back. I hope you enjoyed this brief explanation of modern monetary theory. In this video, I looked at MMT mostly through the proponent lens. If you are interested in a critique of MMT, let me know. Please like, share, and subscribe, and I will see you next time.